Hi, everyone, and welcome back to the Deep Dive. Today, we're getting into something really crucial for any business looking to grow, working capital loans.
That's right. A topic that sounds maybe a bit dry, but it's actually fundamental.
Exactly. So our source material today includes a pretty detailed video called Working Capital Loans for Business Growth.
Mm.
And we've also got some specific info related to a company called Joe Starcher Funding.
Mm-hmm.
So our mission really is to unpack what these loans are. How do they actually work? And why are they presented in these sources anyway as a smart move for businesses?
Yeah, why are they a good idea?
Okay, let's unpack this. And here's where it gets really interesting, I think. We're going to look at how these loans might help a business stabilize cash flow or even, expand without giving up equity, no selling off pieces of the company.
And that no equity part is huge for a lot of founders.
Yeah.
What's really fascinating here, I think, is how this specific kind of funding hits on, well, very common business headaches, pain points, right? Because working capital, at its heart, it's basically the money you need for your day-to-day. Think current assets minus current liabilities, the cash on hand.
Right, the operating funds.
Exactly. So these working capital loans, as the sources point out, they're designed to give you fast cash for those things, the everyday running costs.
Like what specifically? Payroll, rent.
Yeah, things like payroll, absolutely. Or buying inventory, maybe you get a sudden big order. Or maybe bridging the gap while you wait for clients to pay their invoices. That can be a big one.
Oh, definitely.
The waiting game.
Or navigating those seasonal slowdowns the sources mentioned. Revenue dips, but you still have bills to pay.
Gotcha. So it's not for like buying a new building or some massive long-term project.
Generally, no. It's more about keeping things fluid, operationally speaking, and being able to jump on immediate opportunities.
Okay, that distinction feels really important. It's not just any money. It's money for these specific, often short-term needs.
Precisely.
And the sources seem to really emphasize the flexibility and the speed. Yeah, speed is a big one. That's kind of their selling point. The sources pitch them as a game changer because of it.
For small businesses trying to keep stable, or maybe bigger ones wanting to move fast on something.
Exactly that. And the advantages they highlight, well, they're pretty compelling for those short-term situations. We're talking fast approvals, sometimes, apparently, really fast days, maybe even hours.
Wow, okay.
And flexible repayment terms. That's key, too. Often, they can be kind of tailored to match up with how a business's cash actually flows.
Which sounds very different from traditional bank loans, right? Those can take ages.
Vastly different. The process, the structure, often much more rigid with traditional loans. This is built for speed and immediate liquidity needs.
Okay, so that speed and flexibility really jump out. Let's talk about the example, Joe Starcher Funding. How do they sort of fit into this? Do the sources say how they embody these features?
Good question. Well, the sources present them as like a trusted partner because they focus on that speed and tailored approach. They even mention, interestingly, a quick text option to get info instantly.
A text option. Okay, that definitely signals speed.
Right. It speaks volumes about prioritizing businesses that have, urgent needs, that focus on being accessible, turning things around quickly. It means a business isn't stuck waiting for weeks, potentially missing an opportunity, or failing to cover a sudden shortfall.
Makes sense. And connecting this back to what you said earlier, the big one, growth without giving up equity.
Yes, let's underline that again. It's crucial. You get the capital you need for operations or a specific push, but you're not selling shares. You're not diluting your ownership.
Which means you keep control.
Full control. No new investors getting a say in decisions or a slice of future profits beyond the loan repayment, obviously. For many entrepreneurs, that's incredibly important, preserving their vision, their independence.
Yeah, that strategic independence point is huge. It really highlights how these aren't just, financial tools, they're strategic ones too.
Absolutely.
This deep dive really clarifies how working capital loans are positioned as a really agile, essential option.
Definitely. And what's fascinating here, when you step back, is just how this specific funding type directly tackles those common business pains we talked about. It offers this distinct path for growth that doesn't involve diluting ownership. Fast cash, day-to-day expenses, seasonal help, fast approvals, flexible terms. Great for short-term needs, as the sources say. And Joe Starcher Funding is positioned there as a partner.
Right.
So this kind of raises an important question, I think, for you, the listener, thinking about business finance. How might choosing between, say, equity funding versus a flexible short-term option like a working capital loan,
Yeah.
how might that choice fundamentally change a business's long-term strategic independence, especially as it tries to grow?
Ah, that's a really powerful question to chew on. Some great insights today into how businesses can fuel their growth and really secure their path forward. We hope this deep dive helps you think a bit differently about the options out there.